Happy Monday, everybody. Welcome to another episode of China Update, where I provide you with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Now, before we begin with today's episode, I wanted to make a couple of personal statements to you all. For those who want to go right into the updates, that's fine. You can use the chapter feature to skip to that part of the video. In yesterday's video, I said that we may hit 100,000 subscribers this week. The channel hit 100,000 subscribers within 2.5 hours of that video going live. Now, on Saturday's episode, I expressed my gratitude to you all, to the China Update supporters, both old and new. I won't waste your time by repeating a lot of that, but I will, on this occasion, since the channel has passed this milestone, just say a few words. China Update is a one-man band. I research, write, film, edit, upload, and manage the channel all myself. This is done every day, Monday through Saturday, sometimes Monday through Sunday, as it has been this last week. And I've done that every day for 5 years. I started the channel because I believed that there was a lack of this sort of content on YouTube. I felt that there was a lot of punditry, both very pro and very anti-China, but that there was a lack of channels that were really trying to explore what was happening on the ground in China and trying to help people have a real balanced understanding of the situation. I believe then, I believe now that it was critically important that the world have more informed, more sober, and more grounded conversations about this complex and consequential nation. And if I, through the channel, could, even in just a modest way, contribute to that, then it was worth pursuing. It took 2 years for the channel to reach 1,000 subscribers. I was doing videos almost every day for 2 years, with only a few dozen people watching every episode. But at that time, I thought it was worth it, because if for those few dozen people they got some value and they could better understand this country, then it was worth my time to continue with the videos. At that time, I had absolutely no idea that the channel could get to this size. In fact, it was beyond my wildest dreams at that time. This is all a long way of me saying that hitting this milestone with 100,000, having so many of you join me with these daily explorations of what is happening in China, is quite literally a dream come true. Because of all your support, because of your following of this channel, I now, this year, can move to doing this as my full-time job, something I also never thought would be possible. So I guess, once again, I just want to express my deepest gratitude and thanks. Thank you for sticking with the channel. Thank you for coming along every day as we explore this country together. And thank you for giving me the opportunity to share these episodes with you all. I look forward to 2025. It's an incredibly important year to be following China, and I look forward to doing it with you all together. There will be a special 100,000 subscriber episode at some point, probably in early February when I'm back in New Zealand, because then I'll have a very strong internet connection, and I'm thinking of perhaps doing a Q&A and maybe even a live stream. I will have those details released closer to the time. I'll let you know how to ask questions if that's what happens, and what the details of the live stream will be. But for now, thank you once again. That was a very long introduction. Thank you for sticking with it. Now let's move into today's episode. As China's property market, as well as local governments, grapple with their own deepening crises, the former being the property crisis, the latter being the local fiscal crisis, a highly concerning solution has emerged: settling debts with unsold apartments. Strapped for cash, Chinese developers and now even local governments in some parts of the country are increasingly turning to unfinished or empty housing units to pay off their obligations in some strange warped barter system. It is worth stressing this point again. There are so many empty apartments, and local governments are so cash-strapped that local governments in locations across the country, especially in the poorer regions, are now beginning to settle debts in unsold apartments. According to US outlet The Wall Street Journal, in a piece exploring this published over the weekend, in one notable case, Xinjiang East Universe Gas agreed to take over 260 unfinished apartments in Changji City's French-themed residential compound to settle a $25 million debt in overdue gas bills. The company plans to sell the apartments, keeping any surplus proceeds or absorbing losses if sales fall short. This approach underscores the severe cash shortages faced by local governments and state-owned entities. Changji City Construction Investment Development, the primary debtor in this case, reported $1.8 billion in liabilities, but only had $97 million in cash by mid-2024. The trend extends beyond Xinjiang. Companies such as Mona Lisa Group, a Guangdong-based tile manufacturer, and Sunfly Intelligent Technology, an LED producer, have similarly accepted apartments as payment. Mona Lisa accumulated $19 million worth of properties, while Sunfly settled $50 million in debt by acquiring 334 apartments from developers, including Country Garden. Even public entities like police departments have turned to this strategy. In Guizhou province, which regular viewers will know has long faced what is essentially a de facto bankruptcy situation, police departments in Dejiang, Yuping, and Sinan settled $10 million in debts by coordinating apartment purchases through developers. China's property market, burdened by an estimated 90 million empty housing units, faces mounting challenges. Local governments, once flush with cash from land sales during the property boom, now struggle with ballooning debts and shrinking revenues. And as we will see later in today's video, there are other desperate moves they have resorted to as well. The resulting cash crunch has led to underpaid civil servants, rising labor disputes, and cuts to public services like education and healthcare. Meanwhile, housing values continue to depreciate as prices in major cities have fallen for 17 consecutive months. Experts warn that while using apartments to settle debts offers a temporary fix, it reflects deeper structural issues in China's economy. Obviously, local governments and developers will need long-term strategies, including diversifying revenue streams and boosting market confidence to stabilize the property sector. For now, however, quote, getting half-built apartments is better than getting nothing at all, end quote, as one expert put it. Now, while we're on the property sector, bond financing in China's real estate sector fell 18.4% in 2024 compared to the previous year. It shows potential for recovery as new policies begin to take effect. That is the optimistic view, at least, according to a report by the China Index Academy published over the weekend. Developers raised 565.31 billion yuan, $77.1 billion through debt instruments last year. Although bond financing has been declining since the latter half of 2021, year-on-year growth resumed each month since September 2024, aided by a low base effect from the previous year. The sustainability of the recovery, however, remains uncertain. The cost of bond financing decreased significantly in 2024, driven by interest rate cuts, structural changes in financing enterprises, and adjustments in product offerings. Despite the reduced costs, the scale of bank issuance shrank. Credit bond issuance fell 18.5%, overseas bonds plunged 69.5%, and asset-backed securities declined 13.6%. Looking ahead, developers face ongoing challenges in 2025. The report suggests exploring alternative financing channels, extending debt maturities, and refinancing existing obligations to stabilize cash flows and navigate market uncertainties. Next up, we have one more pretty incredible development to cover, but before that, we have this year's first sponsored feature. Now, regular viewers know this, but I think it is worth repeating since there are many new viewers to the channel. I believe it's incredibly important, and I've always tried to be fully transparent with how this channel is financed. China Update typically has 1 to 2 sponsored features per month. There are 2 reasons for this. The first reason is this allows the channel to be financially sustainable while still ensuring that it is primarily supported financially by subscribers. The other reason is that I believe having 1 or 2 approximately 3-minute financial asset type sponsored features is far less invasive a viewing experience than, say, having 3 or 4 1-minute sponsored features per week. I personally select which sponsored features I go with, and I think very carefully about what would be of interest to the viewing audience. Sponsored features will always be labeled throughout, so you know that you're watching one rather than regular China Update coverage. And if you would like to know how I work with sponsored features, including my criteria, this is in the description below. The The world is going through historic changes as trade and the global order fragments, and the US brings back mining to prepare for a new Cold War with China. This is a time of great change, but great change also means great opportunities for savvy investors looking to take advantage of these trends. The US is 1 week away from swearing in a president whose stated goal is drill baby drill, unlocking the country's vast riches. In February 2021, right after Joe Biden took office, the market cap of Giant Mining, BFGFF, the sponsor of today's video, was around $100 million US. Today, Giant Mining has a market cap of $7 million, plummeting 93%. But this is where opportunity is. On November 15th, a major bill passed the House of Representatives. It is called the Critical Mineral Consistency Act, and it will go to the Senate next. Arizona Congressman Juan, the sponsor of the legislation, explains that the goal is to fortify commodities logistics domestically and includes copper, electrical steel, silicon, and silicon carbide to the critical minerals list. Copper Development Association CEO Adam Estelle recently said, quote, "This vote highlights copper's essential role in powering America's energy future," end quote. The legislation specifically ensures copper mine projects are eligible for the Fast 41 permitting process too. This is where the big opportunity for investors is with Giant Mining. Giant Mining, BFGFF, owns a copper project in the world's #1 mining jurisdiction, Nevada in the United States. In the past 4 years, while the share price cratered 93%, management for the company's geologists have actually expanded the copper deposit, and this past September, Giant Mining hit their best ever drill hole. BHP and Rio Tinto, two of the largest copper producers in the world, are warning that copper supply cannot possibly meet the further demand for artificial intelligence and the construction renaissance in the United States. Copper was on the rise from below $2.50 to plus $4 in early 2021. In 2025, the copper price is above $4 US. Meanwhile, historic underground mines at the Majaba Hill project, which is part of Giant Mining, produce copper, tin, and silver from the early 1900s through the 1950s. The infrastructure is ready to go now too. Access roads, power supply, transportation, water supply, all stockpiles and a processing plant. With 1 week to go until Donald Trump's inauguration, all of these factors lead to a significant bullish opinion about Giant Mining. 93% below its all-time high, legislation that puts copper top of mind, an increasing mining-friendly administration, and a serious asset in Nevada. This is a speculative play, high risk, but also a potential very high upside. As such, Giant Mining is worth considering due diligence on for any savvy investor seeking to take advantage of the historic changes we are seeing in the world today. We remember that all investment involves risk. This sponsored feature is not individual investment advice. Always speak to an investment professional and do your own due diligence before making any investment decision. A big thank you to Giant Mining for sponsoring this episode of China Update. Now, we return to regular China Update coverage. This week, Qatar-based Al Jazeera published a piece about one Jane Meng, a pseudonym for a 31-year-old wealthy owner of an import-export business from Shanghai, to explore the issue of China's ongoing millionaire exodus. Over the last 5 years, Meng had steadily diversified her financial dealings beyond China. Hong Kong became her primary business hub, and more recently she opened a bank account in Singapore, relocating much of her wealth. Her rationale is straightforward. Quote, "China is not in a good place right now." End quote. Meng's concerns mirror broader economic challenges facing China. Sluggish growth, a protracted property market slump, and high youth unemployment exceeding 17% have eroded confidence among affluent individuals. Additionally, the government's sweeping crackdowns on technology, finance, and private tutoring industries, coupled with high-profile cases like the disappearance of investment bankers, have unsettled business communities. As we will see shortly, there is another incredibly concerning trend which is also on the mind of many millionaires. These anxieties are driving a growing wave of capital flight. In 2023, China saw 13,800 high net worth individuals leave the country, with projections indicating that number could rise to 15,200 by the end of 2024. For context, this exodus represents a fraction of China's 6.2 million millionaires, but signals a potentially troubling trend. Singapore, with its robust financial infrastructure and proximity to China, has emerged as a preferred destination for relocating assets. The city-state has seen an influx of wealth management offices and luxury home purchases by wealthy Chinese. Meng, who once lived in Singapore, sees it as her natural choice for relocation. As China grapples with economic uncertainties and attempts to restore trust in its private sector, the outflow of capital and talent underscores a pressing challenge: regaining the confidence of its wealthiest citizens. And one thing that isn't helping the situation at all is a shocking practice we've been following on China Update for some time now. The so-called distant water fishing. That is a euphemism for the practice of local governments in poorer regions typically arresting rich businessmen from wealthier parts of the country, essentially to extort fines out of them. This practice is so prevalent now that Beijing has had to step in with a nationwide crackdown. Last week, the powerful National Development and Reform Commission published guidelines discussing the, quote, problems such as profit-driven enforcement and distant water fishing, end quote, while the State Council issued a, quote, document on strictly regulating administrative inspections on companies aiming to curb arbitrary inspections and effectively ease the burdens on companies, end quote. The situation is quite serious too. As Chinese financial media outlet Caixin writes last week, quote, fines and confiscations are a growing source of local government revenue, jumping from 130 billion yuan in 2011 to 428.4 billion yuan in 2022. In the first 11 months of 2024, local government incomes from fines and confiscations increased almost 12% from the same period a year ago. Debt-laden regions are more dependent on this income, especially at the municipal and county levels, where fines make up 84% and 82% of local revenue respectively, with public security agencies, courts and other judicial bodies being the primary authorities involved according to the study. End quote. 84 and 82%. Now at this point it is worth stressing that this is in some localities. It shows how some poorer parts of the country are in really dire straits, but it is worth stressing that this is not the case in some of the wealthier parts of the country, especially the Tier 1 cities and Tier 2 cities in coastal regions. Still, however, this is a very concerning trend. Now let's finish with this observation by veteran China analyst Bill Bishop. Quote, the central government has gotten serious about trying to stop these business-destroying extortions, but many local governments are desperate for revenue and will go where the money is. So until the centre offers better solutions for the local government fiscal problems, the squeezing of business for revenue will probably not go away. End quote. Okay, that is today's episode of China Update. Thank you everybody once again for your incredible support up to this point. I look forward to the year ahead, exploring and trying to understand China with you all together. Thank you for watching today's episode. Have a good Monday, have a productive week, and I will see you all tomorrow.